So in all markets, we hear a lot about what the Federal Reserve is going to do. Are they going to adjust the rate? Are they going to lower it, keep it the same? And a lot of people have a misunderstanding that is how our mortgage rates are directly impacted. And it's not. The way our rates are impacted is through the bond market. So we're going to take a few minutes now and talk that through. And by the end of this, you're going to understand how the Fed's rate doesn't directly affect the mortgage rates and what to keep an eye out for and when you might expect rates to go down as opposed to back up. So what is the Fed rate? Well, the Fed rate is a short-term interest rate. It's adjusted daily, and it's the interest rate that banks charge one another to loan each other money to meet Federal Reserve requirements set by the government. So each bank has to have a certain amount of money in their reserves to be available to their client. If a bank doesn't have that money for whatever reason in their banks that day, they can borrow from other banks at the Fed's reserve rate in order to satisfy that requirement set by the federal government. They may give the money back the next day. They may give it back in a couple days, a few days, or a week or so, but it's a short-term loan, and that interest rate is appropriate for a short-term loan. And that's why it changes quickly, but it's also pretty low. So now we know that the Fed rate is a rate for very short-term loans, and that's one of the reasons why it's low. But if it's so short-term, what the heck do investors use as their baseline to invest in longer-term loans, like mortgages, right? We need to match the time horizon of an investment and the risk to something other than a very short-term loan rate, which could be a day or a couple days or whatever. So to do that, they use the 10-year Treasury bonds, which is typically considered one of the safest investments as it's guaranteed by the U.S. government. If you buy a 10-year Treasury bond, you will be paid out the interest on it. So it's a very good baseline to use for long-term investment. Even for mortgages that are going 30 years or something, the 10-year Treasury is the appropriate thing to use. So what affects the 10-year Treasury yield? Well, hold on and we'll tell you. So there are a few things that'll drive the Treasury yield up, right? The interest rate on a 10-year Treasury yield. And that's inflation or inflationary expectations. Is money going to be worth less in the future? And if so, I need the money I'm making now to compensate me for that. If the economy's doing great and booming and investors have other options that they can invest in and gain a higher yield, the government needs to raise those interest rates in order to be competitive with alternate investments. And then also if the Feds raise their short-term interest rates, right? So if I can get a little bit better return over the course of a year, as opposed to having my money tied up in a 10-year, if I'm going to put my money in a 10-year Treasury, I need to be compensated for that additional time risk. So these things push the 10-year Treasury bond yield up. So now we know that when Treasury yields go up, mortgage rates are going to go up. And when Treasury yields go down, mortgage rates will go down. But why are mortgage rates more than a Treasury rate? Why do investors require a higher return from mortgage than a Treasury bond? Well, it's because there's more risk. A 10-year Treasury bond is guaranteed by the government. You're going to get paid back the percent that they say they will. In a mortgage, an investor's taking a slightly more risk, not a ton, but a little bit more risk, investing in a loan to a consumer who may default on it. And so in order to accommodate that, there's about a 1.5% to 2% spread between the 10-year and the mortgage rates. So if you look at the data in the charts, you'll see it's consistently about a 2-point spread going both up and down as rates rise and fall. So on the flip side, we do want to talk about what causes interest rates to go down. So recession, inflationary concerns, global insecurity or volatility or concerns about the global economy. These are all things that'll drive interest rates down, and that will affect the mortgage rates going down. So if people are uncertain about the vitality of the economy, they are going to want to safeguard their assets, and investors will take money from more risky assets that return a higher interest rate, and they're going to put it into the 10-year Treasury or similar, as it's backed by the U.S. government, and they have effectively a zero risk of getting some return on their money. And since we know that the mortgage rates, because they're investment instruments, follow the trends of the 10-year Treasury, when those go down, mortgage rates follow, and there's about a 1.5% to 2% spread between those two rates. So here's the kicker. If you're waiting for interest rates on your mortgage interest rates to go down, and you're waiting for a Fed to announce an interest rate cut, you're behind the time. Investors are forward looking. they invest and trade on expectation. And if their expectation is that in the future, the not too distant future, the Feds are going to lower rates, that activity is already playing out ahead of time. That's why we saw interest rates on mortgages dip before the last interest rate cut, the Fed rate cut. And then we saw mortgage rates bounce back up. So why would they go back up after a Fed announcement? Well, we know the Fed rate is a very short-term rate and isn't directly associated or correlated with the 10-year Treasury or mortgages. But it's also because a lot of investors that took advantage of the rates before have now sold their investments and causing the interest rates to go back up on the 10-year Treasury. It could also be that they looked at the numbers and the results and the data from the work, the employment reports, or inflation reports, and decided maybe things aren't as rosy as we thought. We do demand a higher rate still, and they bounce back up. So there you go. The bottom line is the mortgage rates follow the bond rate, not the Fed interest rate. The Fed interest rate is short-term, bond rates are long-term, and mortgage investors match their time frame to the 10-year Treasury yield, which is considered the safest investment for investors. So if you want to be thinking about when rates are going to go up or down, keep an eye on the bond market. When the bond market goes down, mortgage rates are going to go down, but you better jump on it, because by the time the Fed releases an announcement of a rate cut, rates may be bouncing back up. If you like this, subscribe and like. We'll be putting more of this information out. Reach out if you have any questions. Thanks.